Happy Friday out there, friends. This is Darius Dale here to present our macro minute for Friday, September 16th, 2022. It's triple witching day in the equity market, so I wouldn't read too far into what you're seeing on your screens today. Next week, things will be real. But anyway, looking at asset markets, stocks are down today. Commodities are flat. Crypto down, dollar up, global bond yields up. Market moving headlines, so a bunch of them today. So global growth cycle downturn deepens. You got FedEx plunging as much as 21% pre-market after withdrawing its earnings forecast, citing significantly deteriorating global freight demand, specifically citing Asia and Europe. So that's something to call out. I think a lot of investors are interpolating this as it relates to S&P earnings, but the reality is, if you look into the release, they're actually citing global demand falling off a cliff as the reason they're withdrawing their earnings. Anyway, geopolitical tension between Germany and Russia escalates. So you have Germany taking over Russia's Rosneft German unit, including stakes in 3 oil refineries. It's obviously an escalation between the standoff between the two countries and marks another step in the country's increasingly active role in the energy industry. So it's unclear how Putin may respond to this, but it's definitely a step in the wrong direction if you're thinking about European gas flows, et cetera. So definitely keep that on the radar. We got core inflation data out of Europe for the Eurozone and Italy this morning as well, both pushed to new all-time highs. That's continuing to perpetuate expectations of monetary tightening over in the ECB, and obviously rising yields across the curve throughout Europe from obviously extremely depressed levels. Those rising yields across the curve in Europe are contributing to higher yields on the at the margins here in the U.S. Treasury market as well. Shifting gears to South America. So Lula appears to be back in Brazil. For those of you who probably have no idea who Lula da Silva is, but he was a big president in Brazil, or not a big president. He was a president in Brazil when they overcame their big inflation problems in I want to say in the early 90s or late 90s, early 2000s. Very popular guy, but I think he went to jail for some Petrobras bribes or something like that a few years ago. But he's back. He's back out. So the latest poll suggests current President Jair Bolsonaro's late campaign push may have fizzled, leaving him a bit further behind challenger Lula. Just 2 weeks to go to the Brazilian election. A Datafolha poll said Lula would take around 45% of the first round vote, hurting firm from what the signal was a week ago, and Bolsonaro would win 33%, down 100 basis points from the previous poll. So it looks like Lula's going to take it. Lula's he's been market friendly in the past, so it's not like this is a necessarily bad thing. But I've been doing this for, I don't know, we're my 14th year of this now, and every story in Brazil is always, well, if they can get the fiscal situation under control, this is going to be great. And it never gets under control because most of the fiscal spending in Brazil is indexed. So guess what? It's probably not going to get under control this time. Anyway, shifting back to Asia. So Xi is playing it safe ahead of his quote unquote re-election bid. It's really not a re-election. Well, technically it is, I guess, but it's the Chinese Communist Party. So let's keep a grain of salt on that. But anyway, Putin's first meeting with Xi since the invasion brought mostly hot air. They met in Uzbekistan, I believe, this week, more than 6 months after they said there were no limits to their bonds. Turns out there have been a few. So Putin would liked more strong condemnation of the West and official pledges of economic support. He walked away with basically the bare minimum. We saw the headlines on Thursday. And then lastly, the crisis in Chinese property sector deepens. So we had Chinese hard data come out for the month of August. Retail sales accelerated, industrial production accelerated, unemployment rate ticked down. It was positive, but the Chinese stock market was down, over 2% today, to down 5% month over month. My read through of that is that it's because this real estate downturn is actually deepening and going in the wrong direction. So you had real estate investment slowed by 100 basis points to minus 7.4% year over year to date through August, which was the lowest level we saw since the depths of China's nationwide lockdowns in March of 2020. Property price inflation slowed across the board. So first-tier cities slowed to 2.9%. That's the lowest we've seen since December 18. Second-tier cities slowed to minus 1% year over year in August. That's the lowest print we've seen since September 2015. And third-tier cities slowed to minus 3.7% year over year, which is also the lowest we've seen since September 2015. So definitely going in the wrong direction in China. In my opinion, I think China's, it's becoming increasingly clear that China's in a liquidity trap. And moreover, not only are they in a liquidity trap, but, based on previous guidance in terms of, the central bank really kind of panicking in terms of its reference rate with respect to the Chinese yuan, it seems like they're not going to be able to continue to ease, if they don't want the Chinese yuan to really materially break through this seven handle. Don't forget, China's also, food and energy importer as well, and they don't want to have a big inflation problem on their hands. Obviously, they're seeing the aftermath of that all across the world, not just developed world, but emerging world as well. So, China's in a tough spot here, because they can't stimulate. They got zero COVID. There's political instability. This is just, and then more importantly, they're overvalued if you look at our relative valuation metrics in the equity and credit and fixed income markets. So it's just not a good situation. And obviously, this is the second largest economy in the world. So this is probably an issue that, FedEx is citing in its reports. But anyway, big movers. Sorry for the long diatribe there, but a lot of stuff going on today. We'll see how it all shakes out this week. I know one last thing. We get the at 10 o'clock today, we get the University of Michigan 5 to 10 year forward inflation expectation report. If that thing ticks up, we're doomed. Anyway, Ethereum minus 3% to down 23% month over month. Guess what? If you bought the merge, if you bought the highs of the merge, you're getting, I guess this thing I saw a hilarious tweet today. So someone said Ethereum must have merged with the Turkish lira. That's a really nerdy finance joke. And then lastly, 30-year nominal Treasury bond yield up 6 basis points to up 42 basis points month over month. And this is in a month where inflation expectations, if you look at 10-year inflation swap rates, are actually down slightly, and 2-year inflation swap rates are actually down quite a bit. So this is a real indication that the incremental supply of quantitative tightening is really weighing on the long end of the Treasury market. Just not where all around the world, there's just not enough demand for long bonds amid this inflation surge, amid the current US dollar currency surge, et cetera. Getting into our risk management, and I'll let you go. US dollar, that is bullish FAMs in the middle of the range. Gold, bearish FAMs, getting towards its oversold. Got about 1% of downside left there. Bullish FAMs, Treasury yield, not quite overbought, about 9 basis points to go there. Bullish FAMs, high yield credit spreads in the middle of the range. S&P 500, neutral FAMs, more or less in the middle of the range there. So downside in the S&P to around 3,800 here. VIX bearish VAMs, getting close to overbought here, about 1% overbought, but it's bearish VAMs though. So if the things break back to neutral, you'll see the upper boundary of the probable range shift. So that's something we talked about in our research at 42 Macro, which is the S&P 500 and broad U.S. equity indices have been exhibiting very low levels of very depressed levels of a 2-month to a 25-50 delta put skew, which means investors have been very unwilling to reach for downside protection relative to very immediate term at the money protection. And that, in my opinion, is suggestive of one of two things. One, investors have really largely left the market and don't need to hedge, or it's a view that investors are thinking that the outlook for the equity market has actually improved relative to where it was, over the last, let's call it 6 months. If it's the latter, then we're going to see some accelerated declines here once we get past OPEX and if we break down below 3,900, which was the left neckline of the inverse head and shoulders that everybody thought was forming. It may not be forming today. Anyway, NASDAQ 100. Neutral VAMs getting close to overbought or oversold here at minus 1.9% to go to the downside. Russell 2000 in the middle of the range, outperforming. You're seeing a real outflow from mega cap safety. It's not necessarily helping, small caps, et cetera, but they're certainly not going down. It tells you that investors aren't as long small caps as they had been of things like, mega cap, NASDAQ, tech, et cetera. Bitcoin bearish VAMs, that's right in the middle of the range. Ethereum bearish VAMs, 6% to go to the downside, to the lows. Neutral VAMs, Shanghai Composite, that's oversold. Neutral VAMs, WTI, that is in the middle of the range. Ag, bearish VAMs, middle of the range. Industrial metals, bearish VAMs, middle of the range. So with that, Darius Dale presenting our macro minute for Friday, September 16th, 2022. Best of luck out there and have a great weekend. Cheers.